Hi everyone, I'm Don Singletary and welcome to the channel. I get a lot of comments and email from listeners and viewers, and one of the common questions I get is, why don't you show some losing trades? Because in the live trade of the week I usually show winners, and it makes perfect sense to study the losers too, because of the winners and the losers, only one of those can blow up your account and put you out of business. So we should learn more about it. So today, for that reason, and I'm going to say I hear you, and I'm going to start putting some losing trades here on the channel too, because they are extremely important. I'll have that and some other trading tips coming up right now. Every trader wants to learn how to make profits while putting up the least amount of money in order to do it, or put more simply, how to make a lot of money by putting up a little bit of money. The very high leverage in futures trading is due to the margin method used in a system called the span minimum margin requirements. Currently, the S&P 500 Micro Emini is trading at about 3,678 points. Now, each of those points is valued at $5. So the entire futures contract for the S&P Micro Emini is about $18,390. Now, we only have to put up an intraday margin of about $330 to be able to trade that. That's an extremely high leverage, 55.7 to 1. And this high leverage makes this type of trading very, very risky. Let's look at another example, trading the Micro Emini for the DJIA, the Dow Jones Industrial Average. The current intraday margin is only about $261, and the DJIA is trading near a record high of 29,990 this morning. Each point of the micro futures contract for the DJIA is worth 50 cents, so the entire contract is worth $14,995. That means a margin of $261 offers the very high leverage of over 57 to 1. Now here's a trade where I made a big mistake. I bought two DJIA contracts on the 19th of November at 29,396, I think, yeah. And I got out of the trade way too early. You see, there's no drawdown. It gets in the money right away. And it was just going up. My green over red and both over the zero line there. I had the perfect setup. And before I even knew what was happening, I was up about $18. And I just put in an order and got out of the trade. No drawdown. Trade barely over a minute, $18. Now, you shouldn't do this. What I did was get out too early. Remember, the biggest mistake that traders make is allowing your losses to mount up, not getting out. You have to be ruthless about not losing your money. Rule number one and all that. But also remember, you can make a mistake that I just made here of getting out of a trade too early. I could have made 3 or 4 times that amount of money. And I can't tell you why I did it, but it was fun. And good luck to you. You know, you can't beat yourself up all the time in this trading. You can get it way too serious business and you lose perspective on it. What I should have done was go up and put a stop order behind that, turned it into what I call a free trade because I couldn't lose any money, and then let it go and see what happens. I probably would have made considerably more money on the trade, but hey, it's water under the bridge. Take the money and let's move on. And it was fun. You know, it's really funny in trading. Anytime after a trade is over, with the genius of hindsight, you can go back and find things you shoulda, woulda, coulda done. Shoulda, woulda, coulda. That's where the Easter Bunny lives. It's not reality. It's after the party's over and you can look back and be the Monday morning quarterback. Well, what I had done on this S&P trade is that I had seen the market from about 11 o'clock in the morning until after 1 o'clock in the afternoon, a couple of hours. I was working at my desk on everything, and I had the screen on and I was watching it. And in this area here for that 2 hours, you see the spaghetti lines down here just crossing over and reversing, and it's 10 minutes up and 10 minutes down and 15 minutes up and 5 minutes level. There's not a lot of a big trend going on, even though the market is up from where it opened at 9:30. So when I saw these dojis up here, and the fact that right here it looked like the market had wanted to go up and that the bears got control again. And then I looked down and I saw the MACD, and the vertical lines are kind of topping off. They look like they may be ready to take another run down in this up and down type day that we're trading. And I thought, well, I'll try it. But I did do something right on this trade, because before I got into it, I looked at the volatility. Now, look over here on the right scale. Even though the market's going nowhere, it's only varying about 5 points for 2 hours. Now, I don't know what your experience is, but lately in the volatile markets we've been having, this is just not very much at all to try to get there. So I decided that I was going to see, because of the dojis and because it was at the top of this midday range that it was trading in, that the next move might be down. So I shorted one S&P contract, and now I'll go to the live screen and show you what happened. Okay, so I've given you my reason and logic, whatever of it there was, for the trade, and I'm now short one S&P Micro Emini at 3561.5. And I see my down at the bottom there, see the vertical green lines do look like they're topping off there, and at this point it looks like I've made a good trade, because it certainly looks like it's going to trend down now. And I'm up a whopping 50 cents a quarter now in the trade. Not a great start, but not terrible. No, I'm down $1.25, and I decide that this is where I made a good decision. I'm going to put in a stop market order, and I decided at 35.65.50. That's exactly 4 points. Now it's $5 a point, so I put in a $20 stop loss here. That's the worst thing that can happen with the trade. See, my stop market order there is 35.65.50. So that means the worst case scenario on this trade is that I can lose 20 bucks. The blue line is where I'm short, and the red line, 4 points up at 35.65.5, is where my $20 stop loss is. And it's a good thing. I use a lot of mental stops where I don't put in a hard stop. In other words, actually enter the order. That's a hard stop. But I did this time because I did not want this trade to get away from me. It's a good discipline to do that on days when you can look and tell what kind of volatility is going on. And what happened to me here is the market turned on me about 5 minutes later, and I'm trading at 35.65, and it's very, very close to being stopped out here, and there it was. So there you go. That's a great example of using a hard stop instead of a mental stop. A mental stop, you have more flexibility because you can change it quickly during the trade. But if you do put in an order with a hard stop, you can always change it too during the trade. And sometimes a hard stop will keep you from making that terrible, fatal beginner's mistake. Oh, I'm down $20. I tell you what, I really think it's going to be all right. I'll risk $40. And then it becomes 50 and 60. And if you have a habit of doing that, you're going to blow up your account. And that right there, you're not stopping the losses at a reasonable amount. You're going to make a mistake once in a while, no matter how hard you try and no matter how much experience you have. But you have to keep those to a minimum, and you have to be aware so that you don't let those losses run. And also, as in the first trade I showed you today, another mistake is taking a profit too quickly when you could have made a lot more money. It's always a delicate balance, and I always tell you, you never have enough information to make the perfect decision. So don't give yourself analysis paralysis and have it cost your account money. I've been going on Tastyworks today, and as I do in all the videos here on the channel, and there's a broker link below where you can find out more about that. If you haven't seen my book yet, it has everything you need to get started in one place, including a great chapter on trading psychology. Now, the videos on the channel are free, And I use the proceeds from the book to kind of support the channel here. So if you can help me out on that, if you value the videos, and I hope they have some value for you, I hope you'll remember that, and I appreciate that. This is Don Singletary, and I hope every day is a payday for you. And thank you.